This segment is sponsored by Dennis Goins of DennisGoins.com. Hi, I'm Lady Charmaine, and we're back with financial advisor Dennis Goins. How you doing, Dennis?
I'm doing fine, Lady Charmaine, and yourself?
Good. And I know today you want every taxpayer to know their rights, and you told them also you want them to file with care. So can you talk to us, because we know that April 15th is just around the corner, and how can taxpayers know their rights? I didn't even realize we even had rights. So can you explain that to us?
Absolutely, Lady Charmaine. One of the things that the listeners don't want to do is mess with the IRS. They can go where no one else can go. They can go into your bank account. They can take your assets. They can put a lien on your home. So you need to know what your rights are and file with care. And in June of 2014, as a part of its ongoing effort in communication, the Internal Revenue issued what we call a formal taxpayers' bills of rights. And these rights have been pretty much scattered throughout the tax code, but surveys have found that most taxpayers didn't even know they had rights when dealing with the IRS. So although you might be comfortable in understanding these rights, it's important to remember that the gentler, kinder IRS remains vigilant in auditing returns for accuracy. So here are some tips that might help you stay out of that 1% of individuals that have their returns audited. Taxpayer Bill of Rights number 1 is the right to be informed. Taxpayer Bill of Rights number 2 is the right to quality service. Number 3 is the right to pay no more than the correct amount of tax. Taxpayer right number 4 is the right to challenge the IRS's position and be heard. Very interesting. Mm-hmm. Taxpayer right number 5, the right to appeal an IRS decision in an independent forum. Again, interesting. The right to finality, the right to privacy, the right to confidentiality, and the right to retain representation, and the right to a fair and just tax system. So these are the 10 taxpayer bills of rights. And let me just say that part about the confidentiality. I had a client call the other day and said they tried to file their return and it had already been filed for them. What happened is somebody had accessed their information and had filed and got their refund and had taken off with their refund. So you got to be very careful and very, very cognizant when you're filing online, because there's a lot of fraud going out there as far as the IRS returns. So you got to understand these rights, and the key thing again is you want to stay out of that auditing range. So to avoid that, you need to check your math and personal information. Although a math error may not lead to an audit, it can put attention to your return. The same is true for entering incorrect personal information, such as a wrong Social Security number, or forgetting to sign your return. You want to stay below the radar. All this information can cause your return to get on the radar. You want to file your return, file the forms on time. Missing a filing deadline often leads to a response from the IRS, although not necessarily an audit. Even if you file an extension, you must pay all the taxes due by the regular filing deadline. Again, you want to stay off that radar. You want to report all income. Very critical here. This is important, because this gets into an issue as far as evasion. Tax avoidance is not illegal. Tax evasion is illegal, and they will put you in jail for that. So you need to report all your income. Even income that's not on your W-2 form needs to be reported. These sources of income might include investment income, interest, royalties, rent, compensation as an independent contractor, forgiven debt, alimony, tips, gambling winnings, health insurance reimbursements, and this would be for expenses deducted in a previous year. and proceeds from sales on online sites such as eBay. Many types of income may be reported by the payer to the IRS, but even if the income is not reported by the payer, it would be wise to include this on your tax return. And that happens a lot when people sell investments. The company that holds your investments is going to report that to the IRS, so they're going to look for you to make sure that you claim that on your return. So they know, so they're looking for you to show that on your return. And finally, you need to use good judgment when you're taking deductions. Use all the deductions that are liable, but keep in mind that certain deductions tend to raise red flags. Amongst the most common red flag is home office deductions, vehicle expense deductions, and high valuable charitable contributions. You need to follow all the legal requirements and keep all the necessary records, particularly if you go to a charitable event. Not all that money is necessarily deductible, so the charity should give you a receipt or coupon of how much of that is a tax-deductible expense. So before you take any specific action, and this is very important, you should consider consulting a qualified tax professional. Mm-hmm. If you get a letter from the IRS and they come looking, trust me, you need to have a professional that's there on their side, because they might, even though they perceive to be kinder and gentler, and I've personally been in an audit, and I'm a financial professional, you got to have your stuff together. And if they ever call knocking, it's highly suggested that you go in those meetings before you say anything with a qualified tax professional. So now that I've scared everybody, what do you think about that?
Yeah, you've scared us all. The very good information, though. You gave us really something to think about, but you did let us know that we do have rights. And even this one right here, number 4, the right to challenge the IRS for a position to be heard. That's really good. Many of us probably feel like we don't have a voice. And then number 5, the right to appeal an IRS decision in an independent forum. Those two are definitely great nuggets for myself and for the audience.
Absolutely, and that goes back to the issue about having a tax professional. And there are issues that the IRS may interpret the law a certain way, and you can challenge that. Specifically, for example, there's a new law as far as IRA rollovers. It used to be, as I mentioned before, where you could roll money from one IRA or take money out of one IRA and put it back within 60 days. And then take money out of another IRA and put that back in 60 days, and it's not a taxable event. Well, now the IRS has changed that effective January of 2015. Now, you can only take money out of one IRA and put it back within 60 days. Because what people were doing is they had 5 or 6 IRAs, and they just take it one out from the other and never had to pay taxes on that money, and kind of helped them when they were short on cash. Well, the IRS got hip to that. And they no longer allow me to do that. But that law, that was challenged in court, and of course it got turned down, but still it was challenged. In addition, there's several other issues that the IRS is challenged on. Sometimes they win, sometimes the taxpayer wins. But you got to be cognizant, and you got to have a financial professional, particularly when they start asking for information. Where you have a problem is if you give them the wrong information and you give them that radar, and you got to make sure that you have all your ducks in a row, all your information. If not, then you can have serious problems.
Well, if somebody wanted to talk to you more about this, where can they reach you?
Well, let me first say that I'm an investment advisor. I'm not a tax preparer, but they can give me an office, and my office a call, and I can refer them to several CPAs that I work with in my practice. But they can contact me at my email address at dennis@dennisgoins.com, and of course my website at www.dennisgoins.com. But that's very critical, particularly for self-employed business people. One of the biggest challenges for starting a business is taxes, not paying your estimated payment on a quarterly basis, because when you have your own business, opposed to when you work for somebody, the employer sends the tax withholdings to the IRS. Well, you're responsible to do that yourself. And a lot of times, based on cash flow needs of the business owner doesn't send the quarterlies in, and when it's time to pay the IRS, they basically don't have the money. Well, that hits you in a big hole that can go deeper and deeper and deeper. And that's a challenge for small business owners as far as paying your estimated quarterly payments. But again, we've had a lot of response from these segments. I've had a lot of people that contacted me on some of the topics we talked about. But the main thing is, do not mess with the IRS.
Well, thank you so much for leaving that with us. Do not mess with the IRS. You know what? That should be a slogan. Again, thank you so much. That should be a song somewhere, right? I know, that's right. Well, we look forward to talking to you next week and hearing some more of these wonderful, I'm going to call these hot topics, because we're in tax season right now and all the information you've been given is great. Thank you so much, Dennis, and we look forward to talking to you next week.
Very good, Lady Charmaine. Thank you very much.
Thank you for listening. If you would like to learn more about financial investments, contact Dennis Goins at dennisgoins.com.